All right, welcome back. We're doing Disney. So this one has been popping up way too many times for me to ignore doing a valuation on. Real quick, let's look at the share price history and some of the ratios. It's been dropping for the last year. I mean, it's down close to 25% if I just take from the peak. So yeah, down almost 25%. And you can look here at some of the ratios. It might give you a little indication as to why, right? The PE is 138. That's usually just a sign that a company had a couple negative quarters and it's starting to come back up, but the average is so low that the trailing 12 months PE, which is what this is based on, is super high. The price to book is 3, price to sales 4. Okay, it is what it is. So let's talk about some shareholders / people who bought options in Disney, right? All right, so first up, y'all know I really like to look at 13F filings for other investors and hedge funds. 13F filings show at the end of each quarter what the holdings were in those companies, okay? So in addition to the investment companies, I really like to look at insurance companies too, because the way insurance companies make their money is by taking the premiums that you pay them every month for your insurance. They invest that, and then when the time comes that they have to pay you back for like your claim or something, they pay you back your money, but they keep all the investment gains that they got. So to be successful as an insurance company, they have to make good returns, right? It's not like being a good hedge fund manager where you can rack in fees from being a good salesman and just never really get great returns. Insurance companies kind of have to get good returns. So, my favorite one to look at, of course, is Berkshire Hathaway. That's Geico. I also look at Progressive. And then the top dog of all insurance companies is State Farm, okay? So let me pull up their 13F. Okay, so this 13F is for Q3 2021. So this is their holdings as of 9/30/2021. And this is on Whale Wisdom. This is free, or at least I use the free version. I think it's a little delayed because I use the free version, but I like it. Okay, so look at their biggest holding. Guess who? The mouse, all right, Disney. They have almost $6 billion in Disney stock. Now, recently they did sell some, but you can see here they sold a lot of shares, right? I mean, them holding it as their number one position is a pretty strong signal, in my opinion. On top of that, there's a YouTube channel, Jimmy from Learn to Invest, who I have a lot of respect for, who revealed his portfolio and showed that he has, I think it was like 17% of his portfolio in Disney or something, 15%, I forget. But anyway, he usually comes up with pretty similar valuations as me, but I think he's definitely had a much better recent track record if you take things like his Activision play, right? Congrats on that today, huh? But the nail in the coffin for me was whenever it came out that Nancy Pelosi had purchased call options of Disney. And I don't think anybody has a better track record of predicting recent stock movements than Nancy Pelosi. She's really good at it. And she's also the source of our quote of the day up top. I'm just kidding. All right, so my problem with Disney, though, is that I look at it from a surface level, and for the life of me, I can't figure out why this would be a good investment, okay? Now, I'm looking at it from a high level. That's usually what I do with stocks. So what I want to try to do is build a bullish case for Disney by looking at their financial statements and their Q4 release and take some, I would say, optimistic assumptions, and maybe, who knows, maybe I'll see the light by the end of the video. All right, let's get started. Income statement first. We're going to fly through a lot of this just because I want to spend some time looking through their earnings release. Total revenue, all right, dipped for COVID, that's to be expected, right? And then recently coming back up. Like to see that. All right, pre-tax income, let's see, where is it? Oof. All right, they did not get the message that the revenue's going up and they should be going up too. All right, I think everybody knows that their theme parks and their cruise line just got walloped by COVID, right? So I'm going to take the assumption that they're going to get back to at least their pre-COVID pre-tax income levels, which would be about $4 billion a quarter in pre-tax income. So up here in the calculator, 4 times 4, 16 billion. I'm going to put that here as my old pre-tax number. Now let's look at earnings per share real fast. I'm sure I'm going to see the same trend, but I just want to look at it. Yeah, same thing. All right, my issue here, though, is that their downturn started, when was this? Their downturn started June 2019. That was way before COVID. I'm sure there's more to that story, but that's just a kind of a red flag for me. All right, well, let's go to the balance sheet. We're going to focus more on the income statement once we get to the valuation section. All right, first up, total tangible assets. So remember, this is everything the company owns minus intangible assets like goodwill and intangible assets. Okay, recent spike here, that was the acquisition of 21st Century Fox, right? All right, and now what I want to look at is a return on tangible assets on a pre-tax basis. Let me make this a percentage. And you can see before COVID, they're making 20 to 30% return on tangible assets. That's actually pretty good, especially for a company that operates with a high asset base like a theme park. All right, so this is what I wanted to do. I want to do a projected pre-tax based on return on tangible assets, okay? So this is assuming that management said, okay, we're making 20 to 30% on assets in our own business. So what I want to do is use their return on assets of like 25% and apply that to their recent purchase. So their recent base, you can see, is $100 billion. So they went from $60 billion to $100 billion. So what is 25% of 100? I need the calculator. Okay, 100. I'm just kidding. Okay, 25. All right, so this is very optimistic. But remember, I'm trying to build some optimistic cases for valuation, right? All right, let's go to debt to equity. Let's see how leveraged they are. All right, they're close to 1, which is pretty impressive, especially that they just went through this huge downturn as far as earnings go. So you can see here, this is why we like to see low debt in a company, right? Because if you got low debt and the downturn comes, you actually have an increased chance of weathering the storm in a way. So, I like seeing that. All right, let's go to number of shares. All right, shares diluted here. That was the acquisition. They went from 1.5 to 1.7. All right, let me just say, if I was a shareholder and I owned a piece of those assets that were getting 20 to 30% on assets, which is incredible, and you diluted me to buy something, you better be making good return on those new assets, because that was, if not, that was slap in the face, okay? All right, tangible book value per share. Oh, I mean, I know why it's like this, right? It's like this because whenever they made the acquisition, they paid a ton of goodwill, I'm sure. So goodwill is just whenever you buy something over the book value, which is what you do every single time you buy stock with a PB over 1. And usually if you're buying a company that's making good return on assets or low debt, you're going to pay higher than just the book value, okay? But still, I just hate being negative on your tangible net worth, right? Okay, so now I want to look into this purchase a little bit more because I trusted them. I'm not suspicious, but I just want to look into it some more. Okay, so let me pull up a great website. I don't know if you know about it. All right, this is Wikipedia. And the great thing about Wikipedia is anybody in the world can write whatever they want about anything, so you know you're getting the best information. If you got that reference, I deserve a like and subscribe for that, right? Okay, here's what I don't like about this. This highlight right here, bidding war between Disney and Comcast for the acquisition of 21st Century Fox. Now, let me just paint you a scenario real fast. If you are going to be on one side of a transaction and you hear that there was a bidding war for 2 buyers for this thing, would you rather be in the seller's shoes or the buyer's shoes, right? Bidding wars lead to maybe overpaying for something, so now I'm a little worried that they overpaid. We'll see, right? Part of being a shareholder in a company is that you are entrusting management to make the right decisions. So it is what it is. All right, that's enough of that. Let's go to the cash flow statement. Free cash flow is first. And here's a silver lining. Look at this. The free cash flow is actually starting to come back up. That's good. One thing that's interesting, if you remember, our pre-tax income was like $4 billion and our free cash flow is way lower than that, like 2 to 3. So that tells me that they were putting a lot more in CapEx than they were depreciating at that time, usually. And free cash flow can be affected by a lot of things, but to have it be depressed for long is usually a discrepancy between depreciation and CapEx. All right, let's look at share repurchases. Yes, okay, right here. All right. So they love their stock. They were repurchasing their stock. They said, man, our stock is great. We're making a bunch of money. We're getting great return on assets. Then they bought 21st Century Fox. COVID happened, and they're like, ooh, we don't like our stock so much anymore. I don't know that. I'm kind of being cynical here. I understand that. But at the same time, I hate seeing this, right? I mean, you were repurchasing. That was going so well. Okay, anyway, now what I'm going to do is something I usually don't do, but I'm going to try to project revenue and pre-tax income in the next couple of years based on their Q4 earnings release. Right, because a stock's worth is all about future earnings, okay? So we look at past results here. That's all we do because I think that's the clearer picture, but it really is all about future results. I just think that past results are the best predictor of future performance, right? Okay, here is their earnings release for 2021. It's not their full annual report, but it tells me enough from what I'm trying to find out. Okay, so what I'm going to do here, and this is going to be another one of those optimistic assumptions, but I'm trying to build a bull case. So I'm going to say that their old pre-tax is going to go back, right? I've already marked that number down, that 16 billion that you see in the outline. But that's their old numbers before COVID, but also before COVID, Disney Plus did not launch until 2019. So what I want to do is look at their streaming income and try to project what kind of pre-tax income they're going to get from that. So I'm going to go down here to segment results, okay? And the segment that has Disney Plus is their direct to consumer. So where is it? It is right here. Okay, direct to consumer. I got it highlighted. And just so that you believe me, all right, direct to consumer here is Disney Plus, ESPN Plus, Hulu. All right, great. You might not know this, but Disney owns 67% of Hulu. Interesting. Okay, so what I'm interested in is this revenue here. $16 billion in their direct to consumer for the year ended October 2021. They end their year on October 2nd. That's strange, but whatever. What's impressive is this number here, right? 55% change year over year. That is insane revenue growth, okay? If they keep that up, that would just be a crazy amount of revenue, huh? $16 billion times 1.55. Let's say they do 55% for the next 3 years. That puts them at $60 billion of revenue, okay? That's just outlandish, huh? Let's see what their revenue was back here in the income statement. What was their revenue? The revenue before COVID was 15 billion. It's crazy. Okay, let me go back. So I think that's a little ambitious, and let me tell you why. Because their subscribers on Disney Plus, let me find it. Okay, their paid subscribers, they have 118 million paid subscribers on Disney Plus. My assumption, which I think is still very generous, but still reasonable, is that they are going to have about the same amount of subscribers as Netflix. And Netflix has, I think, somewhere around 250. Don't quote me on that, but it's close to 250. So I think it's reasonable that their Disney Plus subscriber base doubles, right? I think Disney Plus and Netflix are the only two subscriptions we use. So there's that. ESPN Plus has a lot of room to grow, right? I think a lot of people are cutting the cord and going to be shifting to streaming sports. I know in the beginning of streaming, people didn't like streaming live events because there's always a lot of buffering and quality changes, but it's definitely gotten a lot better. I use ESPN Plus. I don't use cable or DirecTV. Okay, so I think it's more reasonable to say that they could maybe do a little bit more than double revenue growth on their income. So what was it? It was 16. So in the next 3 years, if they got to double 16 would be 32. So let's say they got to 38, 40. Let's say 40, okay? That's just pulled out of a hat, right? But still. Okay, so 40, what kind of growth would that be? 40 divided by 16 over, let's say, the next 3 or 4 years. So 1 divided by 4. So 25% growth, 26% growth. Oh, okay, 26% growth. That's high, but it is definitely fast growing already. I mean, 55, it's definitely much lower than what they've been doing. So I'm not going to say that's completely unreasonable, okay? So $40 billion revenue. So the question is, what kind of income does that translate to? Man, I just realized whenever I pulled up their revenue here that I said, oh, they were only making 15. This was quarterly, so you got to multiply that by 4. So they were making 60 before, okay? Way less crazy, but still very impressive. All right, let's go back. Sorry for that discrepancy. All right, so where was I? What is our pre-tax margin? Well, this is just a streaming service, so I'm going to use the other famous streaming service, Netflix. I'm going to look at their pre-tax margin and say that on Disney's streaming services, they're going to be able to get close to Netflix's margins. That is super oversimplified, but in my opinion, sometimes less is more. All right, so let's go to Netflix's pre-tax profit margin. And if anybody hasn't seen this website, this is an amazing website. It's probably as close as you'll get to my Excel sheet that you see on these videos. It's called macrotrends.net, and I'll link it. Let me just show you how easy it is to use real fast. Okay, Macrotrends. This is the home page. I'm just going to type in Netflix. Oh, well, first you got to spell it right. Okay, Netflix. Click on anything, and then here it is, margins, pre-tax profit margin. How easy was that? Okay, so you can see Netflix has been running at about a 20% margin right now. And they want to raise their price. Sneaky. Okay, so I'm going to say that they're going to be closer to these margins down here whenever, a couple years ago for Netflix, so 13%. All right, so back up in the calculator, 40 billion times 0.13, and that would be another $5.2 billion of pre-tax income. Okay, so if I add that to that 16, 21.2 for projected pre-tax income. Pretty interesting. All right, let's go to valuation. I'm going to do something a little different here. I'm not going to use the earnings per share formula. I'm not going to use the DCF formula, which knocks all this out. All I'm going to do is take 3 different pre-tax formulas, right? So I'm going to put my old pre-tax in this first box. I'm going to do the other one here based on ROA, and then my super fancy Netflix margin one over here. All right, so first one was $16 billion. So 16 times 10 divided by the number of shares, which is 1.82 billion. And I get a price target of $88 a share. All right, the next one is going to be that projected pre-tax from the ROA that's on the balance sheet section of my outline over there. So 25 times 10 divided by 1.82. That's $137 a share. And lastly will be the one that I used the earnings release to project based on the streaming service. So that's 21.2 times 10 divided by 1.82. And I get $116 per share. All right, so my average price target is 114. Share price is 152. To be honest, I think I use super optimistic metrics and I'm still not at the share price. I'm still not sold on this being a buy. But also, if they start turning around that pre-tax income as fast as my optimistic projection showed, like look at this. If they start getting up to $5 billion in the next by 2023 or so, like right here, the multiple on this stock is going to be much higher than 10 times pre-tax. There's going to be much more confidence in them. You're going to be multiplying the pre-tax income by probably 15 minimum. I don't think that means that it's at a different value. I just think that it's going to have better public sentiment. And that is not a reason I usually buy a stock because I don't like to count on that. But anyway, that's my take on it. So if you're familiar with my videos at all, you're going to know that this falls into my too hard bucket. I think there is definitely a path forward for the company where the share price could catch up to and definitely exceed where it is right now. But it's not going to be a roller coaster I'm going to get on, okay? It's too dark ahead. It's like Space Mountain or something, right? Okay. Anyway, that's all I have. If you liked the video, if you learned something, please like and subscribe. For more, I'll see you next time.